Good Friday afternoon, folks, and welcome to Weekly Commentary. And what a surprisingly good week it's been for all of us. Going into the week, if you had only looked at the headlines, that is closed shipping lanes, rising oil prices, and a fragile ceasefire, you might expect the markets to be selling off. Instead, they pushed on to new highs, new all-time highs, and positive for the year. So what exactly is going on? Why are markets moving forward when logic would suggest that they would be holding pat at best? Up until this morning, the Strait of Hormuz was closed. Oil prices elevated and geopolitical tensions seem to be building. But then we got a key update this morning, and that is Iran's foreign minister announced that the strait is now completely open. Market reaction was immediate and to the positive. Stocks, they're now higher than they were at the start of the conflict. In fact, higher than they've ever been. Oil prices today dropped about 10%, back down into the low 80s. Energy stocks pull back. The VIX, the fear index, it moved lower too. In other words, markets aren't just stable. They're actively looking past this situation and onto better days ahead. Earlier this week, the United States took a more aggressive stance, that is, blockading the strait and turning back ships that were engaging with Iran. You might have expected that to trigger some panic and oil prices spiking above $100, fears of escalation, and then broad selling in the markets. But that didn't happen. And I think the reason, kind of simple, I think the markets understood that the blockade has shifted leverage. Before the blockade, Iran could keep the strait closed pretty easily and apply global economic pressure for leverage. After the blockade, the economic pressure shifted onto Iran, and quickly. And I think that has likely forced their hand, and the markets, they've anticipated something like this was going to occur. Now, the war isn't over by any stretch, and the final outcome is still uncertain, but investors are clearly betting this won't leave a lasting economic impact, at least not in the United States. So attention is already shifting back to earnings, economic data, and fundamentals. And right now, momentum is clearly on the side of the bulls. In fact, some are suggesting that this could be the next leg in this bull market. It's been a secular bull market. Now, stepping back for a moment, it has been certainly a volatile year. First, we had the AI-driven sell-off in software stocks, which dragged down the tech sector and brought the broader market down with it. Now, just as things stabilized on that front, war broke out, and that brought another wave of heightened volatility. Yet here we are again with markets pushing higher. So if there's one takeaway from this activity over the past few months, it is this: stay disciplined in your investment approach. It's easy to react to headlines, but the real question is whether these events are actually leading to a broader economic downturn. So far, there's little evidence that they are. And if that's the case, then you need to be patient. We need to ride through the volatility unless we see real reason, concrete long-term reason not to. That said, there are still risks. If the conflict escalates, oil prices move to the $130 range and stay there, that would change the outlook. It would clearly impact economic growth, spike inflation, and probably tank markets. But positioning based on what might happen, on the fear of what might happen, causes investors to lose sight of their long-term discipline. Right now, evidence suggests those worst-case scenarios are unlikely. One of the reasons for that is there is a political layer here. The trajectory of this conflict has been heavily influenced by the president and his rhetoric. And we've seen this play out before, that market performance matters to him. We saw that again play out last year with tariffs, and folks, we may see it again sometime over the next couple of years. So the questions remain. Is the market doing the right thing? Are investors doing the right thing? I think they are, although they may be getting a bit ahead of themselves in the short term, but I do think the general trajectory at this point looks positive. Look at rate expectations. Last week, the odds of a 2026 rate cut were 14%. This week, they're 45%. We started the year with expectations of virtually 100%. That kind of shift highlights just how uncertain the current environment is. Right now, we're seeing sentiment move with the headlines, move with rhetoric coming out of Washington. It's moving with employment data as it fluctuates, and inflation is sending mixed signals. In an environment like this, with all the noise and uncertainty, it makes sense to wait. Give it a month or two for some kind of confirmation as to whether or not the bull case is going to remain intact. In the meantime, the economic foundation, looks strong. Earnings growth is in double digits and consumers continue spending. They're resilient. That is a backdrop for staying patient, and that's what we're going to do. Folks, I'm going to be traveling next Friday, but I do plan to be back with my next update the following Monday. Until then, have a wonderful weekend.